Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Conservative hybrid funds are hybrid mutual funds that invest 75% to 90% of their total assets in debt instruments and the rest 10% to 25% in equity. It is prefixed with conservative because a majority of its assets are invested in debt securities, which are considered to be highly safe avenues. But can the conservative category beat other fixed income instruments available for investments? And after the change in debt taxation, how can one approach conservative hybrid category? Let's understand all of this with Kaustubh Belapurkar, Director of Fund Research, Morningstar Investment Adviser India. Kaustubh, good evening. Welcome to the show. So, conservative hybrid category, one of the best options for investors who are risk averse. But then, could you elaborate on the kind of securities and allocation this particular fund of these categories have?
Me on the show. So, like you rightly pointed out, Kavita, that there are these various hybrid categories that have been created, and conservative hybrid being one amongst them is most on the more conservative side. And by the mandate, as you see, that's been defined by SEBI, the regulator, the band within which you can buy equities as one of the asset classes is between 10 to 25% of the overall portfolio, and the remaining has to be bought in the asset class, which is fixed income. Now, why is this conservative, and how are most of the funds structured within this? So obviously conservative because we know fixed income securities are traditionally less volatile. Obviously, they will tend to give you relatively lower returns as compared to equities over the long term, but they'll be much more smoother in terms of low volatility, right? Whereas equities, as we all know, have been and will be volatile over the short term, but can deliver reasonably significant returns relative to fixed income over the longer term. And that's why we think of equities as a long-term asset class. So this category combines kind of both of these, obviously with a lower equity allocation. And what we have seen, most of the funds within this category, and there are quite a few here, tend to operate while the band is 10 to 25%. Most of them are closer to that 20 to 25% equity exposure, because that becomes what we would think a reasonably meaningful exposure within the perspective of the portfolio, and the remaining goes into fixed income, across sort of buckets there. So I think that's the way the funds are constructed on the conservative hybrid side.
All right. So, considering the entire interest rate hike scenario, how have these funds performed so far in last 6 months, say?
So actually, the funds have gotten the benefit, if you think about it, on two factors, right? So one is obviously over the last over this last 6 months, obviously we've seen that interest rates have been, they were moving up, and now probably you've seen some slide in the interest rates. But I think broadly, a lot of these funds don't necessarily, take very, very aggressive duration calls. And the other thing is, even in the equity side, will be a more flexi-cap portfolio. So I think it's a good mix of both for an investor who's looking to come in. But obviously, even within that, you would see funds that may hold more securities and some going down the credit ladder. So I think that's the other thing that investors will need to keep in mind. But obviously, over the longer term, and we think these are funds that you're not buying for, maybe from a 6-12 month perspective. We would think at least from a 3-year perspective, given that almost a quarter of the portfolio is in equities, and we all know equities can be reasonably volatile, as it's been over the past year or so. So you need to have that time horizon, which ideally we would think about 3 years minimum is probably a good time to buy this, and ride out the volatility, right? Because I mean, if you're losing, say, 10%, if equity markets correct by 10% and you're holding 25% in equities, that's about 2.5% down on the fund overall, right? So that there can be volatility, like I just expressed. So I think it's important to keep that right time horizon in mind, and then you can have pretty sort of good return expectations from the funds.
Now, post the change in the tax structure for debt investments, what do you think is going to impact this particular category?
Yeah, that's a very fair question and point. And what we think of when you think about these funds, right? They're not. Firstly, they're not. I wouldn't think of them as pure replacements for fixed income funds. I think that should be very clear to investors, because clearly they carry a quarter of the portfolio in equity risk. So I think that's a very important thing. It needs to be looked at from an overall portfolio asset allocation perspective, right? So classical case is that if you're an investor who's largely bent towards fixed income but wants some equity kicker, you could do it two ways, right? You could either buy a conservative hybrid fund, which will give you 75 debt, 25 equity exposure, or you could separate the two, right? That you buy a fixed income fund for 75% of your portfolio and 25 through an equity fund, right? And obviously, with a new taxation regime, people might be thinking of the latter because on the equities, you would still get a beneficial taxation. Otherwise, if you buy a conservative hybrid fund, you would be kind of, living with fixed income taxation for the entire portfolio. So that's obviously one of the quandaries. But I think, from an investor's perspective, the other important thing to keep in mind, especially for very, very conservative investors, when I think of it behaviorally, right, because that's the other important aspect that really needs to be spoken about. When you have these two as two individual funds within your portfolio, a fixed income fund and an equity fund, anyone who's new to the market or just coming in and is very risk averse, when he thinks about equities has fallen 10%, he will see that minus 10% on his equity fund. But when you do it in a conservative hybrid, you'll probably see that the fund's only fallen 2.5%, right? So this behaviorally, it helps investors ride through volatility rather than doing it separately. So I think for investors who are coming in new, who don't know how to navigate, maybe even though the taxation might be a little adverse as compared to buying it separately, it might still make sense because if you get the asset allocation right, that is going to be the biggest driver of your returns rather than just purely tax planning.
You think this category can be compared to a fixed deposit and other traditional fixed income instruments?
Absolutely not. I think that is a distinction that should be very clear because I would, because of the equity risk that this category holds, with that 25% exposure, it has to be looked at when you're building a portfolio and you want equity exposure up to about 25%. Can you do it through a route like this? Then sure. But it should not be a like-to-like replacement for a pure fixed income fund at all. But yes, when you're building a portfolio, you want to do asset allocation, it could be used as one of the options to build that asset allocation.
I can see the kind of recommendations you've made in this category are ABSL Regular Saving Fund, HDFC Hybrid Debt Fund, Kotak Debt Hybrid, SBI Conservative Hybrid, and UTI Regular Savings Fund. Why these recommendations and how different are these funds in terms of their exposure?
So I think in terms of, firstly, these are just a list of, some of the funds that have, probably been the best performers over the last 3 years, as of 30th April. I think more importantly, when you think about also the pedigree of, the asset managers that they come from, and there are probably a few others that would, we could add to the list. One is that they uniformly, all of them, like I said, run about 20-25% sort of equity exposure, which is great. They could have varying levels of fixed income exposure. I won't get into the individual securities, but I think both, all of these are very strong, both on the equity and the fixed income side. So it really blends that quite well in terms of, building that equity, debt plus equity exposure. So I think, definitely something that, investors can look at.
All right, I think that's a lot of discussion on conservative hybrid funds, but I think we need to quickly move on to our viewer queries, Kaustubh.